Let's start with the absolute basics. What exactly is trading? Trading is the act of buying and selling financial instruments like stocks or cryptocurrencies with the goal of making a profit. It's very different from investing. Investing is typically a long-term game. You might buy shares in a company and hold them for years, hoping the company grows and your investment increases in value over time. Think of it like planting a tree and waiting patiently for it to bear fruit. Investing is often passive and focuses on the fundamental value of an asset, aiming for slow and steady growth over many months or years. Day trading, on the other hand, is all about the short term. A day trader opens and closes all their positions within a single trading day. You're not holding anything overnight. The main goal is to profit from small, rapid price movements that happen throughout the day. Instead of a 10% gain over a year, a day trader might aim for a 1% gain in a few hours, but they do this repeatedly. The core idea is to capitalize on market volatility, which is the constant up and down dance of prices. This approach is far more active and requires constant attention and quick decision-making. To get started on your day trading journey in 2025, you need a few essential tools. First, you need a good charting software. A platform like TradingView is the industry standard for most traders because it allows you to analyze price charts with a huge variety of tools. This is where you will do your homework and find potential trading opportunities. Second, you need a trading platform, which is also known as a broker or an exchange. This is the service you will use to actually place your buy and sell orders. Your choice will depend on what you want to trade, whether it's stocks or crypto. Finally, and this is a step many beginners skip, you need a trade journal. This can be a simple spreadsheet or a dedicated notebook. A trade journal is where you will meticulously record every single trade you take. You'll write down why you entered the trade, what your plan was, how it turned out, and what you could have done better. This journal is not just for record keeping. It is your single most powerful tool for learning from your mistakes, identifying your strengths, and improving your strategy over time. Without it, you are essentially flying blind and are likely to repeat the same costly errors. Let's be very clear. The most important factor in your trading success will not be your strategy or your tools. It will be your psychology. You need to completely retrain your brain to think differently about money, winning, and losing. In our daily lives, we are taught that losing is bad and being wrong is something to avoid. In trading, you have to accept that you will be wrong and you will have losing trades. A profitable trader is not someone who wins every trade. That's impossible. A profitable trader is someone who has a system where their winning trades make more money than their losing trades cost them. This brings us to the concept of probabilistic thinking. Trading is a game of probabilities, not certainties. Your goal is to develop a strategy that gives you a statistical edge over a large number of trades. You could have a strategy that only wins 40% of the time, but if your average winning trade is 3 times larger than your average losing trade, you will be very profitable in the long run. You must detach your emotions from the outcome of any single trade. A win that broke your rules is a bad trade, and a loss that followed your rules perfectly is a good trade because you maintain discipline. Now let's talk about the practical side of managing your psychology. Risk management. This is your number one job as a trader. Before you even think about how much money you can make, you must define how much you are willing to lose. Before entering any trade, you must know 3 things: your entry price, your stop loss price, and your take profit target. Your stop loss is a preset order that automatically closes your position at a specific price to cap your loss. This is your safety net, and you should never, ever trade without one. It prevents a small mistake from turning into a catastrophic loss. This leads to position sizing, which is deciding how much of your capital to put into a single trade. A common rule for beginners is to risk no more than 1% of your total trading account on any single trade. For example, if you have a $5,000 account, you should not risk more than $50 on one trade. You calculate your position size based on this risk amount and the distance between your entry price and your stop loss price. This rigid discipline ensures that a string of losses, which will happen, won't wipe out your account, allowing you to stay in the game long enough to succeed. To find trading opportunities, you need to learn how to read price charts. This skill is called technical analysis. It's the study of past price movements to predict future price action. The most common type of chart you will use is a candlestick chart. Each candle gives you a wealth of information for a specific time period, like 1 minute or 1 hour. It shows you the opening price, the closing price, the highest price, and the lowest price. The color of the candle, typically green for up and red for down, tells you instantly whether the price moved higher or lower during that period. One of the first things you'll learn to identify on a chart is the trend. A trend is simply the general direction the market is moving. In an uptrend, you will see a series of higher highs and higher lows. In a downtrend, you will see a series of lower highs and lower lows. Trading with the trend is generally easier and more profitable for beginners than trying to fight it. A simple way to visualize a trend is by drawing a trend line that connects the lows in an uptrend or the highs in a downtrend. A break of this line can sometimes signal that the trend is about to reverse. A more advanced tool that traders use to analyze trends is the Fibonacci retracement. This tool is based on a mathematical sequence discovered by Leonardo Fibonacci and is used to identify potential support or resistance levels. When a price is in an uptrend and then pulls back, traders will use the Fibonacci tool to project where the price might stop falling before continuing its upward move. The 61.8% and 50% retracement levels are considered key areas to watch. Price often finds a floor at these levels, presenting a potential buying opportunity for traders looking to join the trend. Another powerful concept is the fair value gap, or FVG. This is a 3-candle pattern that indicates a strong and rapid price move, creating an inefficiency or an imbalance in the market. It appears on the chart where the wicks of the first and third candles do not overlap, leaving a gap. The market has a tendency to revisit these gaps to fill them, meaning price will often return to that area. For a trader, these gaps act like magnets for price, making them excellent points of interest for setting up a trade entry or defining a price target for an existing position. Having all these tools and concepts is great, but they are useless without a concrete trading strategy. A strategy is a strict set of rules that tells you exactly when to enter a trade, where to place your stop loss, and when to take profit. Building one starts with an observation. For example, you might observe that price tends to bounce off a certain moving average. You then turn this observation into a rule-based system. You must define every single condition that needs to be met before you risk your money. Your strategy should be so clear that there is no room for guesswork during live market hours. Once you have a set of rules, you must test it. You do this through backtesting, which involves going back in time on the charts and seeing how your strategy would have performed. TradingView has a bar replay feature that lets you do this very effectively. You collect data on dozens or even hundreds of hypothetical trades. You need to know your strategy's win rate, your average win size, and your average loss size. If the data shows that the strategy has a positive expectancy, meaning it makes money over time, then you can move to the next step. If not, you go back and refine your rules. After successful backtesting, you absolutely must not jump into trading with real money. The next crucial step is to practice on a demo account, also known as a paper trading account. A demo account lets you trade with virtual money in a real live market environment. This is where you test your strategy and, more importantly, your own psychology. Without any financial risk, can you follow your rules when you see the market moving? Can you handle the emotions of seeing a trade go against you? You should practice on a demo account for at least a few months until you are consistently profitable. Finally, a serious word of warning about leverage. Leverage allows you to control a large position with a small amount of capital. For example, 10 times leverage means you can trade with 10 times the money you have in your account. While this can magnify your profits, it also magnifies your losses by the exact same amount. For a beginner, leverage is extremely dangerous and is the fastest way to blow up your trading account. Focus first on learning a solid strategy and mastering risk management with a small real account. Slow and steady discipline is the only path to long-term success in day trading.